Welcome to your first time homebuyer's guide. In this video, I'm going to walk you through all the steps from beginning to end on your journey to buying your first home. And I get it. You might have some anxiety, you might be a little bit nervous, and that's common. So here's the deal. Those emotions are usually tied to a lack of information and a lack of understanding a specific process. By the end of this video, I'm going to give you some great education so your fear and anxiety drop, your education and information increase, and you feel empowered to make a better decision when you buy your first home. And honestly, I'm making this video because I didn't have something like this when I bought my first home. Not only am I going to help you save some money and have a clear understanding, but I'm going to take you from nervous to excited. This should be a fun process. This is where you're going to live with your family. This is where you're going to have people over and celebrate. It's a big deal. And by the way, for you to follow along with ease, I've created a downloadable workbook checklist that's going to help you stay organized during and after this video. So click the link below to download it now. So before we jump into all the nuts and bolts of getting pre-approved and buying a home, I want to give you a little bit of background on myself and who I am and what my journey's been. I got into the mortgage business 17 years ago. Funny enough, I bought my first home before I got into the business. So I was a first-time home buyer just like you. I had no clue. Fast forward, over the last 17 years, my team and I have successfully helped over 4,000 families and individuals buy a home of their dream. We genuinely love helping people accomplish owning real estate and setting some foundations financially for their family so they can build wealth. Now, I know exactly how you're feeling right now. Generally speaking, it's a combination of feelings because it's an emotional process. It really is. There's definitely some excitement. Buying a home is exciting. Looking online for properties and envisioning yourself in your own home is exciting. But along with that excitement, there's a little bit of fear, there's a little bit of uncertainty, and there's a little bit of confusion. I felt those same exact emotions, and it kind of startled me at first because I didn't know what I didn't know. But at the same time, I met the right people who gave me that education, and that's exactly why we're here today. I want to turn those lights on for you and make sure you know exactly how to go through this process and that you feel empowered to make the right decision. Is the fear and the uncertainty going to go away? No. But as your information and your education increases, those emotions start to subside a bit and you build confidence. But what I really want you to think about is your why. Why do you want to own a home? I wanted to buy a home because I wanted financial stability. My family situation was a little bit shaky. Some people want that same stability. Others want to make a great investment long-term. Some people just need space for their growing family. Work from home, hybrid situation, kid one, kid two. One of my big goals to this day, and something I love to do, is I love to host my family over on holidays. There's nothing better to me than having my entire extended family sitting in my living room. I'm feeding them some good food. We're all laughing, having a drink, and just literally creating memories. Some people are pet parents. They want a yard for their pet. Whatever it is, think about your why and think about how important your why is along this journey. So now that we've established there's some emotions running through, some uncertainty, some fear, some excitement, and we've thought deeply about our why. What is the why for us wanting to become homeowners? Let's take a broad overview and kind of look at the process from day one through closing and getting those keys in your hand. First things first is we have to make sure you're pre-approved. That just means we take a look at your finances so that we can determine if you can comfortably afford your mortgage payments and what price point you need to look at. From there, you meet with a realtor, you start looking at properties, you eventually make an offer. Once your offer is accepted and you've negotiated on a fair price, we have to do a little bit of due diligence, right? So we have to do a home inspection to make sure the home's in good physical condition. And then we have to do a home appraisal to make sure that you're paying fair market value. So there's a difference between the inspection and the appraisal. In many cities, specifically in Chicago, there's going to be an attorney involved to make sure that the contract protects your best interests and that everything is mutually protected between you and the seller. They kind of are there like bumper lanes on the bowling alley to just make sure that the process goes smooth. The next step is what we call underwriting. That's where the bank and the mortgage company kind of take you apart like a financial puzzle and put you back together to make sure your income, your credit, your assets support the mortgage process and that you qualify for your loan. Along the way, we're going to make sure you get some property insurance, just like you have insurance on your car or insurance on your apartment. You have to have insurance on your home, your condo, or your townhouse. Once all the T's are crossed and the I's are dotted, the inspection, the appraisal, the underwriting, the insurance, all that's provided to your bank, your mortgage company. They sign off on everything. They give you the final approval. That means you are clear to close. Everything has been done. Now we prepare for the closing. In preparation of the closing, you're going to meet with your realtor at the property the morning of the closing, and you're going to do what's called a final walkthrough. You probably saw the property 30 to 45 days ago. Now the sellers have moved out. All their stuff should be out of there. If there are any repairs or things that you ask them to make, that should all be done. And you walk through the property once more to make sure visually it's in the condition and the cleanliness that you expect it to be before you get those keys. Then it's judgment day. You show up later at the closing, you bring your check for your money, you sign a bunch of paperwork with your attorney. At that point, there shouldn't be any surprises. You know what you're paying, you know how much you owe, you know what your mortgage payments are. But the closing is a formality. You go through the process, it takes about an hour, you get your keys that day, and the property is officially yours. And the last part is the best part. You get to move into that property, make it yours, paint it, customize it, get all your stuff in there, and start your new life as a homeowner. It's the best. So now that we've gone through that overview of the process and you can kind of visualize each step along the way, let's jump into today's class and the agenda we're going to cover. The first and most important step you're going to take is getting pre-approved. So we're going to break that down. From there, we're going to dive into the three main components of lending. How do you get your mortgage and what do banks look at? Your income, your credit, and your savings. Super important. Then we're going to talk about your budget and identifying the right mortgage payment that fits your budget. So you're looking at properties that align with that payment. That's how you get your budget dialed in. And as we close out, I'm going to explain the importance of having the right people by your side, what I call the dream team, because there's a lot of people involved. There's an appraiser, a realtor, an underwriter, a lender, an inspector, and I'm going to explain who you need by your side and how they're going to make sure you have a successful home buying experience. So let's jump right into getting pre-approved, what that means and what the process is. Now remember, getting pre-approved is how a mortgage company or a bank determines if you qualify for a home and where your monthly payment should be so they fit your budget and so you can comfortably afford those payments after you close. One of the most important elements in the pre-approval process is understanding your income and your employment history. Now, there are different types of industries and different types of ways people get paid. Some people are salaried. They have a straight W-2 base salary. That's it. Others are hourly, where they can work overtime. Sometimes they work more hours in a week. Sometimes they work less. There are a lot of people now who are self-employed. Either you're a freelancer, you're 1099, you own your own business, or you're a partner in a business. And lastly, there are people that just don't have consistent income. You could be in between jobs, on your way out, on your way in, or maybe just retired or semi-retired or living with your family. So what we do as mortgage lenders is we analyze what category of income you fit in. Are you salary? Are you hourly? Are you self-employed? Do you get bonus? Do you get commissions? Do you get overtime? All these details are taken into account because we have to clearly understand what you make, what your income is specifically, and from there we can determine how much of your monthly income can be used to support your mortgage payment. So the next component for getting pre-approved is understanding your credit. Lenders look at your credit score and make a decision on the likelihood of you making your payments on time. So the higher your credit score is, the more likely you are to make your mortgage payments on time. You're going to get rewarded with a better interest rate. If a credit score is on the lower end, that can mean there's a little bit of risk with a home buyer making their payments on time. And as a result, that lower credit score could impact the interest rate, resulting in a higher monthly payment. So what I tell people is your credit follows you everywhere. It's always going to be with you, and it's going to impact every large purchase you make. Buying a home, buying a car, buying a motorcycle, buying a boat, sending yourself to college, sending your kids to college, financing furniture. Your credit score impacts everything you borrow for the entire duration of your life. So you got to take care of it. You got to be aware, and you have to understand how to improve it. So we'll talk about that a little bit today. So sorry to interrupt you, but if you're finding value from this video, I highly encourage you to join my monthly newsletter where I share real-time real estate information that's going to help you along your real estate journey. And I promise I'm not going to spam you. It's real-time information. Click the link below to join the newsletter. Some of the factors that impact your credit are your bill payments. Are you making your bill payments on time? Do you have any outstanding collections? How many credit cards or loans do you have open? Are you opening and closing credit cards all the time? There are 5 to 7 different factors that get averaged into an equation, and every single month your credit score changes. Some months it goes up, some months it can stay neutral, and some months it goes down. The name of the game is live within your means, pay your bills on time, and try not to overextend yourselves so you never have an issue paying off your debt. Now, speaking of debt, debt is the balance of who you owe. So if you have a car loan, if you have a credit card loan, and if you have a student loan, the amount you owe is your debt. And every debt you owe has a monthly payment. A common question mortgage lenders get is, do I have too much debt? Is my car loan or are my student loans too big? And will that disqualify me for a mortgage? That is a great question. The answer is mortgage companies and banks don't look at your debt balance. We look at your monthly payments. Remember, we just talked about income. We have to determine how much money you make every month, how much of your bills are absorbing that income, your monthly payments, and what's left up to a certain amount is what we can allocate towards your mortgage payment. So that's why your credit is so important. We have to look at your debt, how much you pay every month, and we also determine your interest rate by looking at your credit score. My credit score was in the low 600s because I was 21 and I just hadn't had enough time, enough runway to pay bills. I didn't know what I didn't know, but I learned. And as my credit got better, my interest rates came down and my payments came down. So on a scale of, A, B, and C, A plus credit would be in the 720 range or higher. B or average credit is going to be somewhere in the mid to high 600s. And kind of below average credit, or C if I were to grade it, would be under 640. Now, different loans have different credit score requirements. So certain loans allow you to go down into the 500s. Some loans allow you to be in the 600s. And certain loans require you to be in the 700s. Your lender is going to take a look at your credit and help you determine what type of loan you qualify for when you get pre-approved. If your credit is not strong enough, don't be discouraged. Lenders have the ability to look at your credit history and implement some tactics and some strategies to help you build your credit over the next 3, 6, or even 12 months. So when you go to get pre-approved, it's also a time to learn that if I don't qualify now, what can I do to position myself to buy a home in the next 3, 6, or 12 months? That's all part of the process and will help you understand what type of interest rate you qualify for based on your credit scores and how your credit and your debts impact your ability to get pre-approved. So the last element to get pre-approved is understanding your cash or your savings. We talked about your income. That determines how much you can afford every month. We talked about your credit. That lets us know how much debt and how many obligations you have, and it also determines your interest rate. And the third puzzle piece here is your cash. We need to know how much cash or how much money you have saved up, or if anyone's contributing as a gift, because that's where you cover your down payment and your closing costs. Now remember, when you buy a home, you need money for your down payment and you need money for your closing costs, and that comes from typically the money you have saved up either in your checking account, your savings account, a 401k, an IRA. Some people get a gift for their parents. Some people have gotten inheritance from family members that have passed away. There are a variety of different locations where people keep cash. And when we get you pre-approved, we're going to ask you, hey, how much money do you have saved up? How much do you have budgeted? Or how much can you tap into? And once we have that amount, that's going to help us determine what you qualify for, because as you go up in purchase price, you need a larger down payment. As you go up in purchase price, you need more money for closing costs. So everything correlates. We take a look at your income. We take a look at your credit. And so once we understand how much cash you have available to support your purchase, cover your down payment and your closing costs, we can also make a determination if we need to incorporate something like a down payment assistance program where the city or state give you some money to support your purchase, or if we can negotiate a credit from the sellers, literally the person you're buying a home from, they can credit you money back to help soften your down payment or soften your closing costs at closing. We'll talk about that more as we move on. So we've covered the pre-approval process. We talked about the three main components of lending: your income, your credit, your savings. At this point, we should have a good idea to what a buyer qualifies for. And this, in my opinion, is one of the most important yet overlooked pieces of the process, is getting alignment on your payment and your monthly price. What most people did in the past was they found the home they loved, they tried to figure out if they could qualify for it, and they had no idea what their payments were going to be. They ended up getting a loan, the payment was way too high, and after a few months, it backfired. They ended up not making enough money to save, they were living over their means, and that's part of the reason we saw a huge housing crisis and a market crash in 2008. So it's important to understand first where you need your payments to be, and then we help you convert those payments into a purchase price. So when you start the home search, you're looking in a parameter of prices that keeps your monthly payments affordable. Don't find the home first. Determine your payment first, then find the home that matches your budget. There's a specific term that lenders use. It's called your debt to income ratio, okay? We want to make sure that your monthly debts don't exceed a certain portion of your income so you can live within your means. After you make your mortgage payments and after you pay your bills, you should still have a little bit of money left over to live your life, to maybe save up for a vacation, and to save long-term for your financial well-being. What we don't want to do is have you maxed out on a mortgage payment and you have no disposable cash at the end of the month. That's why we talk about your debt-to-income ratio. So as you can see, there are three debt-to-income ratio categories. There's a conservative category, There's an average category and there's a high or aggressive category. Here's how I break this down for people so they can think about it financially and make a responsible choice. If you want to keep your home payments really conservative, you want your housing payment to be somewhere between 18 to 24% of your gross monthly income. So let's go through an example. Let's say you and someone else are buying a property. You each make 60 grand a year, which is $10,000 a month pre-tax. That's the number that the lender is going to look at to determine your debt to income ratio. So if you wanted to keep a very conservative housing payment, you would have a housing payment of $1,800 to $2,400, which is 18 to 24%. A majority of homeowners, which is just data, fall somewhere between a 25 to 28% housing ratio. That means if they earn $10,000 a month, their monthly housing payment is somewhere between $2,500 to $2,800 per month. Now, the average home buyer has a housing payment somewhere between 25 to 29% of their gross monthly income. So for example, if you and your significant other make $10,000 a month, that housing payment would be somewhere between $2,500 and $2,900 all in. Now, this covers your principal and interest, your taxes, your insurance, and any HOAs if it's a condo or an assessment. This debt to income ratio does not account for utilities, cable, gas, things like that. You're going to pay that no matter what. So we're purely talking about just the mortgage payment, including taxes and insurance. The high housing ratio, the aggressive range, house rich, cash poor, nice balcony, ramen noodles in the fridge, that's where you're somewhere between 30 to 35%. Now, even after the housing market corrected, the guidelines still allow someone to have a housing payment up to and over 1/3 of their gross monthly income. I do not recommend that. It's going to be very difficult to save. You're going to feel tight some months when there's holiday season or you got to take a big vacation or maybe something breaks and you have to spend money on a repair. But if you decide that you want a housing payment somewhere in that 30% range or higher and you make 10 grand a month, you're going to have a payment between $3,000 and $3,500 a month all in. Now, something to keep in mind is that the average home buyer moves out of their first home by year 5. So on the first purchase you buy, you want to make sure that you leave money left over to save, because savings and compound interest is going to help you build wealth over time. What I don't want you to do is buy a home, have a really high mortgage payment, and for that first 5 years of your young adult life, you're not saving any money and you're not building wealth. You definitely want your first home to be somewhere in that 25 to 28% range so you can live comfortably, live within your means, and so you can continue savings and earning interest on your money. So based on what we uncovered during the pre-approval process, when we're analyzing how much money you have saved up and we're analyzing where your monthly payment should be so you can comfortably afford them, we're also going to pinpoint the right type of loan for you, and that's going to help us understand how much of a down payment you need. As you can see, there are different down payment options for first-time home buyers. You can put as little as 3% down on a conventional loan. You can put 3.5% down on an FHA loan. If you're buying a 2 to 4 unit, that requires a different down payment. If you're a veteran and you've served our country, thank you for your service. 0 down payment for you. Different loans and different properties require different down payments. Some people have a little bit more money than others. They're able to put more money down to toggle their payments. Other people are limited to a certain amount. So part of what we'll need to determine before you start negotiating and before you make an offer on that first home is exactly what type of loan you're getting and exactly how much of a down payment you have, because that information needs to be confirmed and disclosed when you make your offer. Now, one of the biggest misconceptions that I want to get clear for you today is you do not need 20% down to buy your first home. Now remember, the first home I bought when I was 21, I put no money down. The second home I bought with my wife, we only put 5% down. Nobody is putting 20% down these days, especially as a first-time home buyer. It's just not common because on an early stage in your life, most people haven't had enough time working to save up 20% down. So let me give you an example. If you were buying a $300,000 home in Chicago, 20% down would be $60,000. Most young adults just don't have that much money saved up. However, you can go as low as 3% down. So on a $300,000 home, you really only need about $9,000, which is separate from your closing costs. We took a look at some stats from the last year, and on average, first-time homebuyers were putting down about 6% total. Now that we've covered the down payment details, let's jump over to the closing costs. Now remember, in every real estate transaction, there are closing costs. Sellers have certain fees they pay. Buyers have certain fees they pay. They're standard, they're uniform, they're transactional. They can't be negotiated, they can't be removed. You drive on the tollway, you pay the toll. Same thing with real estate, there's closing costs. So if you're putting 3% down for your down payment, A rule of thumb based on cities, because it varies all over the country, closing costs for a buyer are going to be somewhere between 2 and 4%. So let's just use an even number like 3%. So if you were buying a $300,000 home, you would have to budget an additional 3% for your closing costs. That's $9,000. Let's say you're putting 3% down for your down payment. That's $9,000. Well, all in, you're going to need a total of 6%. 6% for down payment and closing costs times a $300,000 home means you need $18,000 all in. Now, you might still be able to get a down payment credit. You might still be able to get a seller credit. You might be able to use some type of a grant. But a general baseline number that most home buyers should plan on budgeting, if you're thinking through how much money will I need in 6 months and 12 months, is you want to use at least 6%. 3% for your down payment, 3% for closing costs. That cannot be financed. That is all paid at closing in one check the day you close. So we've touched on the down payment. We've touched on the closing costs. We have a good idea of how much money to budget. Let's say you're not quite there yet, or you don't want to fully break the bank and liquidate every dollar you have to your name. You remember earlier on I mentioned down payment and closing cost grants? Well, every city and almost every state offers these. This is a way to support and promote home ownership for young adults and for people that fit certain criteria. Now, some of these grants are tied to where you buy, what part of the city, and some of these grants are tied to how much income you make. If someone's making $500,000 a year, they don't have access to these programs. These are typically for first-time homebuyers buying their primary residence, making under somewhere between $80,000 to $120,000 a year, either individually or joint. So when you get pre-approved, what we do is we take a look at your income, your credit, your location, your property type, and we cross-reference the different grants that are available in your market to help pair you and match you with some money so you now know what you have access to. Some of these programs are grants, some of these are loans. A grant means you get the money, and if you stay there for at least 5 to 6 years, you don't have to pay it back. A loan means you actually have to pay it back every single month, but that might be more beneficial than taking an extra $10K out of your bank if you don't have it. So don't worry if you don't think you have enough money saved. My team and I will make sure that we scour all the different programs because they change every couple years. We'll determine where you are now, what you qualify for, and if we can pair you with one of the assistance or grant programs to help cover some of the costs, either A, that you don't have, or B, that you don't want to tap into, because we always want to make sure that you have enough money saved up for a rainy day and enough money for a repair. And speaking of teams, one of the last and most important pieces of this entire real estate puzzle is your dream team. So you already know who I am. I'm a mortgage lender. I help you get pre-approved. I help you get your budget dialed in. I help you get that education. But you also need a great local realtor who's knowledgeable on the market, who has a good reputation in the city that you're looking in, so they can help you understand what to buy, where to buy, and how to avoid some mistakes. And in some cities like Chicago, for example, every single home buyer has an attorney that reviews the contract and helps them negotiate any nuances so that their best interests are protected. Now, not every state requires an attorney to represent the buyer, but I always recommend you have someone looking out for your blind spots so you don't make any mistakes. The fourth person on your team is a home inspector, and they get brought into the picture once you're officially under contract. They walk through the entire property, checking things like electrical, plumbing, mechanical, furnaces, ACs, the roof if there's a roof, the basement if there's a basement. Their objective is to spot any deficiencies or repairs needed so you know exactly what you're walking into before you close. And last but not least is a home insurance agent. Just like you have car insurance or renter's insurance, you need home insurance. It protects basic things like flood, theft, and fire, and it's required when you're getting a mortgage. Either your lender or your realtor can refer you to a local agent, or you can use the person you've been using for your auto. So at this point, you're ready to close on your first home, and your home buying journey is coming to an end. However, your wealth building journey has just begun. Real estate is the #1 way people build wealth over their lifetime. So I want to leave you with this. It's super important to surround yourself with the right professionals after you close. There's another team you need to know about, and I'm going to save it for a different video. A good financial advisor and an accountant are worth their weight in gold. And remember, a home is not just an asset. It's also a tool that can help you build wealth over time, and that can help you save money when you do your taxes every year. So having these right professionals in your corner is invaluable along your journey. So that's it. you're officially more prepared and informed than 95% of homebuyers in this country. I hope this guide really empowered you and took you from fear and anxiety to excitement. Buying a home is an incredible stage in your life, and I'd be remiss if I didn't offer you an opportunity to connect with my team and I. As mentioned, I've been doing this for 17 years, and I'd be happy to hop on a 15-minute strategy call with you. Whether you're 6 months out, 12 months out, or just have a couple basic questions, my team and I would be honored to support you. Click the link below, let's schedule a time to chat, and I'll see you in the next video.